Good morning. Listed real estate markets have rebounded substantially since touching a bottom last year, October, delivering a very attractive return to those investors who had the courage to buy at the time of maximum despair. With private assets having corrected substantially during the course of the fourth quarter, the question arises if it is now time to switch our attention away from listed real estate and look for opportunities in private markets. We believe that listed real estate is still priced better than private real estate and continue to accumulate positions in our preferred names. Over the next few slides, I provide a few examples to summarize our thinking. Since October, the performance of US, UK, and continental European REITs was 18.7%. This is for the US REITs. 37.09%. This is for the UK REITs. And 39.86% for the European REITs, continental European REITs. Now, for the UK and continental European REITs, I've measured the performance in US dollar, so we have a common currency, to make it comparable to that of the US REITs. As you remember, besides going long REITs last October, we suggested that it was time to remove currency hedges and go long also the euro and the GBP, since those currencies were trading at extreme oversold levels. Next, I would like to share a few slides which I saw during a recent CBRE House View webinar, and they are freely available on the internet. So the first slide looks at the discount of REITs by region relative to REITs. Bear in mind that CBRE is using their own NAV estimate, which are pretty good since they value thousands of assets in the markets in which these REITs operate. So on average, their NAV is already 15% lower than the latest reported NAV of the REITs. So the conclusion is that discounts are still wide and listed real estate is cheaper than private real estate. You can also see this by looking at the current cap rate in a specific market relative to the implied cap rate of within the price of the REIT. So if you take the United States, on average the cap rate in the market, private markets, is 6.3%, whilst at this price with a 21% discount to NAV, the REITs are trading at 7.4 cap rate, which means that if you buy the direct asset, you earn 6.3. If you buy the listed REIT, you're acquiring the same asset with a cap rate of 7.4. This chart breaks down the discount by sector for the US REITs. Now, during their house view, CBRE was not very bullish on the hotels and office sectors. Despite trading at the widest discount, what they commented is that the hotels are a very difficult asset class, and over a full cycle, they deliver suboptimal returns. Offices are challenged because of the work from home trend and accelerating aging of buildings, most of which have poor energy efficient ratings. In their indirect investment portfolios, CBRE has reduced their allocation to offices to less than 5%, and most of it happens to be medical office buildings and life science. Now, they specifically remarked during that webinar the opportunity in industrial and residential REIT, although they also think now that shopping centers may have become more attractive because Those that have survived the pandemic are now in good shape to generate income. The shopping center have changed the mix of their tenants, and they are have a much larger presence of experiential tenants, say restaurants, for example, which typically justify going to the shopping mall. In fact, if you check the holdings of their listed REIT fund, you can see that Simon Properties ranks very high in their portfolio. Also, interesting to notice that the implied cap rate in the REITs is much higher than what can be achieved on the private markets. Take, for example, residential or multifamily. In the market, these assets are trading at a 5.2% cap rate, whilst in the REITs market, you can acquire exposure to the same assets with a 6.4% cap rate. And the same is true also for industrial, for self-storage, and pretty much everything. So finally, CBRE shared this chart, which shows the historical discount to NAV for US REITs, noting that the extreme discounts we are observing at the moment was witnessed only twice in the last 20 years, during the Great Financial Crisis and during COVID, after which the REITs delivered very attractive returns. So in conclusion, the REIT trade is very much on, in our opinion, and we continue to favor public versus private core real estate. Development is a different matter, because on the developing assets in the private markets, refurbishing still has an attractive IRR that can beat the return of the REITs. Now, we believe that the bulk of the return over the next 2 years will come from capital appreciation. REIT yields are attractive, but it is very much possible that dividend per share may be cut in the near future, as REITs refinance debt at higher level, and it takes time for the top line, the rent, to grow to compensate a higher cost of funding. Now, so certainly this is true for many continental European REITs, which are operating at high LTV. You can actually see this in this chart, which I have seen in a recent 2023 market outlook from Stifel, which shows that the European REITs are trading at an average of 40% LTV relative to the UK REITs that tend to trade at around 30% LTV. So what that basically means is the European REITs are riskier than the UK and US REITs, and they are at greater risk of cutting dividends. Nevertheless, the trade in European REITs, it's if based on an expectation of capital appreciation, is certainly a valid one. So thank you very much for your attention, and if you would like to discuss this topic in more details, feel free to contact me. Bye-bye.